Ever wondered how much dividend income you can get from $100,000? Well, let's dive into the intriguing realm of dividend income. We're talking about a type of investment income that flows from owning shares in a profitable company. These companies, in a gesture of goodwill and financial sharing, distribute a portion of their earnings back to shareholders. That's you and me. This is what we call dividends. Now imagine having $100,000 to invest. Sounds like a lot, right? Indeed, it is a significant sum, and the potential for earning is substantial. But here's the catch. It's not just about the amount you invest, it's also about where you invest and how you manage those investments. With $100,000 at hand, the possibilities seem endless. But the question remains, how much dividend income can this sum actually generate? Stick around as we delve into the nitty-gritty details in the next segments. Before diving into the numbers, it's crucial to understand what dividend stocks are and how they work. Thinking of dividend stocks can be much like considering a golden goose. A company that pays dividends is like that goose, laying golden eggs at regular intervals. These golden eggs are the dividends, a portion of the company's earnings distributed to shareholders. Dividends are typically given out as cash payments, but sometimes they can also be additional shares of stock. Now you might wonder, why do companies pay dividends? Well, it's a way for companies to share their success with the people who invested in them. By paying dividends, companies attract investors who are interested in regular income along with potential capital appreciation. It's a form of rewarding loyalty. And who doesn't like rewards, right? Dividends are distributed based on the number of shares you own. Let's say you own 100 shares in a company that pays $1 dividend per share. You'll receive $100 as your dividend income. Simple, isn't it? But here's where it gets interesting. Not all companies pay dividends. Typically, well-established companies with a steady stream of income are the ones that pay dividends. These companies have reached a stage where they generate more profits than what they can reinvest in their business. So they decide to return a part of these profits to their shareholders in the form of dividends. On the other hand, younger, high-growth companies may not pay dividends as they prefer to reinvest all their profits back into the business to fuel their growth. It's like choosing between a goose that lays golden eggs now, or a goose that's expected to lay even bigger golden eggs in the future. So, armed with this knowledge of dividend stocks, we can now start to unravel the mystery of how much a $100,000 investment can generate. The key to estimating potential dividend income lies in understanding the dividend yield. Now you might be wondering, what is this dividend yield? Well, it's a financial ratio that shows how much a company returns to its shareholders in the form of dividends each year relative to its share price. In simpler terms, it's a percentage that tells you how much bang for your buck you're getting from your investment. Let's break it down. The dividend yield is calculated by dividing the annual dividend payment by the stock's current market price. Now remember, the dividend yield is a percentage, so multiply that result by 100 to get your yield as a percentage. Now let's put this into perspective with an example. Imagine you've invested $100,000 in a company that has a dividend yield of 4%. How much can you expect to earn in dividend income? Well, you just multiply your total investment by the dividend yield. So $100,000 times 4% equals $4,000. That means you could expect to potentially earn $4,000 in dividend income from your investment in a year. However, it's important to note that this is an estimate. The actual dividend income can be higher or lower depending on the company's performance, its financial health, and the overall economic conditions. Also keep in mind that while a higher dividend yield might seem attractive, it's not always a sign of a good investment. A very high yield could be a red flag that the company has financial difficulties, and it might not be able to maintain that level of dividends in the future. So, always do your due diligence before investing, and there you have it. The dividend yield is a helpful tool for estimating your potential dividend income, but like any tool, it's most effective when used wisely. So, the dividend yield gives us a good estimate of our potential income. But remember, these figures are not set in stone. While the dividend yield provides an estimate, actual income can vary based on several factors. Now let's delve into some of these factors. Firstly, company performance. A company's financial health directly influences its ability to pay dividends. If a company is performing well, it's more likely to distribute higher dividends. However, if it's struggling, dividends may be cut or even eliminated. Secondly, changes in dividend policies. Companies may alter their dividend policies based on their financial strategies. For instance, a company might decide to reinvest its profits back into the business rather than paying out dividends. Lastly, market conditions. Economic downturns, interest rate fluctuations, and other market conditions can impact a company's profitability, thus affecting its dividend payments. So, you see, even though dividend yield gives us an idea, it's not the whole picture. Therefore, while dividend income can be a great source of passive income, it's important to consider these factors and conduct thorough research. So, what's the big takeaway when it comes to generating dividend income from a $100,000 investment? Well, it all boils down to a few key points. First and foremost, understanding dividend stocks is crucial. They are not just about the immediate returns, they are a long-term investment strategy. Next, calculating dividend yield is an essential step. It's not just about how much money you're putting in, but also about the percentage return you're getting from your investment. It's a crucial tool to compare different investment options. Moreover, several factors can influence your dividend income. The company's financial health, industry trends, and market conditions all play a part. It's not a static figure. It can fluctuate based on these variables. And there you have it. The potential of dividend income from a $100,000 investment demystified. Remember, investing wisely requires knowledge and patience, so take your time and make informed decisions.